Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up. Now, we've been seeing some wild swings in the stock market. In fact, so far, it's been one of the worst starting months for the S&P 500 and the Nasdaq ever. But on Friday last week, we got a rally. The Dow went up 500 points. Apple reported earnings the Thursday before Friday, and that helped drive some buying into the market finally, because we've seen some stocks blow up on earnings. Netflix fell 20% when reported earnings. Tesla was down big on earnings. Intel big on earnings on Thursday, and so was Robinhood. So it's been a market defined by extreme volatility this year. And my goal in my videos is to help you navigate the markets by learning some trading concepts along the way. In last video I did, I talked about the most important indicator to use to pick out the best stocks to buy, and that is relative strength. How a stock is performing in regards to the market averages, the S&P 500, the simplest benchmark to use. Apple was one of the stocks outperforming, but many other stocks that people are most interested in right now are not. And let me show you what is going on. What are people actually doing in this market right now? To point out, lately, Fidelity has a very fascinating thing now on its website. It shows you order flow by customers, ranking stocks 1 through 30 by the number of trades or orders being put in. And it even shows you the ratio of buy to sell orders. Well, Friday, it was all pretty much buy orders across the board here. One exception, Visa. People sold Visa. But everything else, people were just driving in, especially on Tesla. That was the top bought stock, Apple number 2. But if we look at the list, what I see is Apple is one stock outperforming, but almost everything else that people are buying, or a good number of the stocks, are not. For example, Lucid, Intel on the list, AMC on the list, GameStop on the list. Here's Intel, Rivian, Robinhood. So there's a lot of attempt among people to buy stocks that are falling the most. And that's a strategy that really does not work when you're in a market where the averages are trading below their 200-day moving averages. When that happens, the stocks that tend to trade the weakest, when there are market pullbacks, they tend to fall more, and on the rallies subsequently not do as well. They tend to also be more volatile than averages, and that attracts people's attention. And that's one thing I really want to talk about in this video. But let's reinforce what we talked about last week, and that is in regards to relative strength. Here's Netflix that's on that top list. It crashed over 20% in a day, then fell even more. But then it had news that a giant fund manager had bought several $1 billion worth of stock, and I guess some people wanted to jump on that. But stocks that crash like this, they don't go straight back up. And if the market does go lower in the coming weeks, at some point, this is a stock that's likely to continue to go lower. Instead, let me show you how to put the relative strength. I'm using stockcharts.com, and you go to price, and you put in the ticker symbol, Netflix, NFLX, and a semicolon that's to create the ratio. And now it's a simple relative strength ratio. Oops, I misspelled Netflix. It won't work if you misspell. But simple relative strength ratio, you can see it's been badly lagging since November and then crashed. What it does, the ratio compares the price of Netflix to the S&P 500, dividing the two. And when it goes down, it means Netflix is badly lagging. But we can compare that to a stock outperforming. I own this stock, Exxon. It's been a big outperformer. And you can see, the big difference between a stock like Netflix that touched intraday 52-week high, Exxon and Netflix. You're hoping, you buy this, and it's likely to be dead money. You buy this, you can put a stop loss in at 60, the lower below the turn-day moving average, or 70. You kind of have a defined idea where you are. In oil, I think, is a trend along with commodities, higher commodity prices. It's going to continue for quite some time. It's not just, oh, is this a bounce? I hope it's a bounce. I hope this is the bottom. I'm not hoping on this like that. This is an underlying trend of inflation that's helping to drive energy stocks up. It's a big macro picture right now. It's why the Federal Reserve is now poised to raise interest rates 4 times. So the macro trends are what I like to align myself in with, sectors outperforming the market that are linked to those trends. Netflix is not. Netflix was the story stock of 2 years ago. But the problem is, when we look at the list of many of the stocks on here, number one, Tesla, Tesla peaked on the relative strength in November and started to go down into earnings, and it's a lagging stock. So I wouldn't buy it, even though it's number one. This is what people are doing. You got to think differently than what everyone else is doing in markets like this in the long run to be successful. But look, Elon Musk, he sold $16 billion worth of his stock, 10% of his holdings, going into the end of last year. So it's heavy insider selling. I think he knows more than the person putting an order on Fidelity. What do they know about the outlook of Tesla? Elon Musk sold billions. He knows more than I do, more than most people, or anyone probably, when it comes to that company. So again, just take the concept of relative strength with you. And the number 2 stock on that list is Apple, and it's had strong relative strength. So if you want to play a market rally, Apple is a stock to buy to do that, more so than Tesla, more so than Netflix, if that's what you're inclined to try to do. I'm interested in trading commodities, sectors that aren't solely linked to the S&P 500. But let's step back from that, because what most people want to do in the market right now is trade, because what is happening is, from the spring of 2020 to really a couple months ago, most stocks were going up. So you could buy something and hold it and make money. But now that the market is more volatile, more stocks are going up or going down than up. In fact, 70% of the stocks in the New York Stock Exchange are below their 200-day moving averages. Most stocks are they're doing worse than the averages. So this is making an environment where it's becoming much more difficult to hold stocks and do well. Well, to give you another example, one of the stocks on that Fidelity list, look at Robinhood. This stock has been lagging the market all year, and people are trying to buy the bottom. Is that the bottom? It was up 9%. So a lot of people are guessing it is. But even if it is, what is it likely to do? Probably go up a little more and then go sideways into a stage 1 base for months on end. It's not going to have a sustainable up month after month rally. It's going to have to build a base. That's what stage 1 basing is about. But Rivian is also on the list, and Rivian is in a death spiral. It had one up day, and people think that's the bottom. They're guessing that 50 is the bottom, but the company doesn't have any real revenue to speak of at a massive valuation. So, it's very difficult to know that that's the bottom. Lucid's been underperforming since December, and that's another one people are buying. So I would stay away from those kind of situations. Now, another topic I want to talk with you about is looking at the market from 2 time frames. What's the time frame you're looking at the market with. Because most people look at the time frame of what's happening that minute. You know, if you load up, if you turn on the television, you see the ticker right there. It's showing you that second how much the market is up or down during the day. You know, we look at this at the top. This is the closing prices. You know, people go home, they see the closing prices. Okay, that's daily action. But that daily action is fairly meaningless in itself. You know, it doesn't mean anything. So people, what they tend to do is like their count's going up, they're happy. They look at a green day, oh, I'm happy. Or it's going down, they're losing money, which is what's been happening over the past couple of weeks. Then they see an update and they're like, oh, okay, everything's like, maybe this is the start of something. But it doesn't really tell you anything. You have to use charts to put the daily action in context. And then with charts, I use 2 time frames. The first is a daily time frame. So that's a daily chart, you know, and I like to go and look at a year's worth of data. So here's the S&P 500 on a daily price chart. And what we've seen is we've had a sharp decline since January, and then the market went sideways last week and closed, well, it fell below the turn-day moving average, the green line, and then closed right below it. So what's going on here? Well, one thing to keep in mind is that markets on a daily time frame fall faster than they go up. So, you know, we saw the stock market has had a very fast pullback in January that S&P did. They really took place over 2 weeks. The thing is, markets fall faster than they go up. Well, most people think it's bottomed, but assuming it has bottomed, it will take more time for it to make a new high than it did to have just fallen. What it will have to do is probably go up a little bit more and then go sideways for several weeks, perhaps several months, and then break out and have a rally to the upside. It's not just going to go straight up like in a week at 4,800. And that's the bullish case. And then, you know, the bearish case is doesn't go up much more, or it goes up a little bit and then it drifts and then it starts going down, you know. But the reality is, just looking at this chart is not enough to determine which of those scenarios are more likely. We got to look at more information and more data to figure that out. But what we can see on this chart are where the price resistance levels are right now. So we've got the 200-day moving average, which is closed right on, and then the 150-day moving average of 45.15. Now keep that number in mind, because another way to measure resistance is what they call retracement levels. And typically the 1/3 retracement level is first resistance after a drop, then the 50% retracement level. Well, we closed on the 1/3 level, or right below it, on Friday, and the next level is the 50% level, 45.15. So that coincides with the 150-day moving average. So that's likely the resistance level that we're going to see challenge the S&P 500 if it continues to go up in this coming week. Now that's 1.8% higher than where it closed Friday. To me, you know, that type of trading to buy now to try to get, let's say, 2% and then see what happens, it's not worth doing. You know, if I want to buy the market for a rally, for a big rally, that's not a big enough rally for me. I would frankly just wait and see how this plays out, because if it's going to really rally up to the highs, as I said before, there's going to be base building, there's going to be some sideways action, you know, in the weeks to come, and then you can evaluate. So that's the way I think of the market in the bearish scenario too. If we're going to go lower, you know, then you want to lighten up on rallies. Personally, I reduced my risks last year when the internals of the stock market began to decline. I did a little bit of hedging in December, which isn't that important. But my focus is to be in things outperforming the market averages. I'm not really trying to trade the S&P and jump in and out. But when so many stocks are not acting well, what happens is many people think, oh, I can no longer hold stocks. Now I got to trade them. You don't really have to trade, I believe, if you're in Exxon, if you're in energy stocks, if you're in commodity stocks, if you're in gold and silver. But you do if you're playing, Netflix or Tesla or the QQQs, because the moves aren't sustainable. The current rally that began Friday is not a sustainable rally. It will peak out, and then we're going to see the market drift or go lower or consolidate, sideways action. And then we'll have to see how it plays out. But the troubling thing in the market to me is that still, most things overall are still lagging. This is the Russell 2000. It broke down, and it's so far away now from the 150-day and 200-day moving averages that it's in a stage 4 decline. Those moving averages are going to be stiff resistance. It's going to take a long time. It would take a long time, even if it bottomed, for it to get above them. And the Nasdaq is in a similar situation. The 50% retracement level on the Nasdaq is 1504, well over 1,000 points away and above the 50% retracement. So the Nasdaq has fallen so much that the 2/3 retracement level is now where the 150-day moving average is. So that's how much damage has been taken to the Nasdaq. So this is a market that's taken a big hit in the first 2 weeks of January, and most people aren't concerned about that. To show you what I mean, in past declines when the market bottomed, I would get phone calls from people where I live that are just regular investors worried about the market, asking me if they should sell. This happened in January 2016. It happened in December 2018. And there were people obviously concerned in March 2020. But I haven't seen any evidence of people concerned, at all. Not a single phone call on social media. I see people either saying, this is whatever. I'm not worried. You got to be a long-term investor, or they're buying, or they're looking for bottoms. And this bears out in search engine data. This is Google Trends. Look at the word stock market. It spikes when people are concerned, which tends to coincide with stock market bottoms. When the masses are selling and in panic, that's really what generates long-term bottoms. But, look at this. The last spike, March 2020 was a massive one, April 2020. But this is barely up at all. In the previous spikes, coincided with December 2018, January 2018. There was a flash crash in the Dow that led to a rally into that August. So we're not even at that amount of concern and consternation about the stock market. And then you go back to August 2015, there was a flash crash. 2016, concern. 2008, the number of people concerned. Obviously, that was a major crash time. So there's very little concern at the moment among people about the stock market. The S&P is only fallen 8%. The Nasdaq has fallen more. What is happened is that ARK, the very speculative stocks, crypto, things like that, have really gone into serious decline. They're remaining deep in bear markets. That's causing a lot of people to lose money. But look, the average person in their 401k investing in the S&P 500 or Vanguard funds, they're not losing much money. All that's happened is the market has come down around 8% for them. that's not enough to cause panic. It's not enough to, much less cause the Federal Reserve to say, oh, we can't raise rates now. You know, you gotta think outside of what's going on with the highly speculative stocks, because more people look, only, not many people are really buying or investing in AMC. It's only the most active day traders and self-directed investors that are. And it's an awful trade because it's badly lagging the market. It's been doing that since June. The way to trade is to get in things where that relative strength line is going up, not trending down for months on end. That's an awful, awful trade. And there's no reason to think that just because this was up, 3% on Friday, that this is the start of a rally back up to new highs or back up to even 30. It had a rally in December from 20 to 30, and now it's at 15. So why can't this go to 20 and then go to 10 later? Where's the bottom in this? And the same is the story for Robinhood. Yeah, it's a good update, 9%. Wow. But, why does this mean it's, how can you predict based on one day of action like that it's going to go up huge? Now, I talked about 2 time frames, daily charts being the first, and we looked at that trend on the S&P 500 using daily charts. But the next time frame I use is 60-minute charts. This is a 60-minute chart of the S&P 500. The indicator at the top is an oscillator to gauge overbought and oversold conditions. When it's above 80, it says overbought. And you can see that when that has been above 80 in January, and then crossed back below 80 to give a sell signal, the market fell. That's the kind of thing you see during market downtrends. Now it's headed, apparently, it looks like it's heading back above 80. And it'll probably get there early this week, unless the market, just dumps suddenly on Monday. But if it goes up or is sideways, this indicator is going to go above 80. Then I'll be having to watch to see when it's going to cross below it, because that would trigger a sell signal. And I might actually use it to put on more hedges than I have against my long positions in the stock market. But you can see I put the retracement levels on here. 45.16 is the 50% retracement level. Strong rally Monday. I think that's where we'll see. That's here's the Nasdaq is dealing with the 1/3 retracement level. It would take a really huge rally to get to the 50% retracement level, much less a 2/3 retracement level, which is where the 200-day moving average on the daily chart actually is. So what I like to do is use the daily charts to interpret the overall trend in the market, and look at these hourly charts to pinpoint where I might make a trade entry point on the markets. So to me, an entry point, frankly, is if I wanted to go long, I would put stops on the lows of Friday. If I wanted to sell some stocks, lighten up on a rally to reduce my risk in my account, I do it when the hourly stochastics get above 80. And if I want to short or buy puts or take on hedges, I would do it when the hourly stochastics get above 80 and then cross below it to generate a sell signal. Now, if you're not familiar with that indicator, just go to Google, type in stochastics, stock market, and you can find all sorts of articles about them. They are the easiest overbought and oversold indicator to use. Now, they're not 100% accurate all the time. No indicator is, but it's one that's, when it becomes good at picking out the overbought readings don't work when you're in a strong uptrend, and oversold readings don't work when you're in a strong downtrend, which you can see from the S&P indicator here. the oversold readings are when it's below 20. Well, the oversold reading in around the 19th gave a buy signal when it crossed above 20, and then the market dumped. So that's the type of thing that happens when you're in a strong downtrend. I would say that strong downtrend ended last week, and we're now, we went sideways, and now we have the potential to break a high and go a little higher. We're going to encounter a resistance. Then we'll have to see what happens. So this is going to be an interesting week. I'm trying to show you how I interpret the stock charts, and also how I actually look for stocks to buy. They're kind of different. This is short-term action, and that's what the market is now forcing anyone who wants to trade the averages to do, short-term trades until there's real stabilization that lasts for several weeks, not just, a Friday up day. So all that said, if this is the first time you ever seen me, get the next video, click the like button, and YouTube will know that this information is useful. It's not hype. It's not what you see most people doing right now. And then YouTube will show it to other people, which will help other people. But click the subscribe button, then click the bell next to that, and YouTube will then send you a notification as soon as my next video is up. And have a interesting and good trading week. And I'll be talking with you later on.